A wide, clean street in Frisco, Texas. Brick-faced homes, manicured lawns, stone driveways without a single crack. Each house nearly identical to the last. 3-car garages, the kind of neighborhood that looks like everything is perfectly fine. Inside one of those homes, a family sits at a kitchen table made of pale oak wood, granite countertops, recessed lighting humming softly above, engineered hardwood floors still carrying that faint new home smell. On the table, there's an envelope. The family has been putting off opening it for days. When they finally do, the number inside reads $22,400, due in 90 days. Not a mortgage bill, not a tax notice, a special assessment from their HOA. They didn't miss a single payment. They didn't violate any rules. They did everything right. And yet, $22,400 is now legally owed. This is not a rare story. Across the United States, something is quietly failing from within. Most of the people living inside these walls have absolutely no idea it's already happening around them. To understand what's happening, you need to understand what an HOA actually is underneath the brochure. A homeowners association is, at its core, a private government binding you the moment you sign. When you buy a home inside one, you legally agree to pay dues every single month. You follow their rules. You submit to financial decisions made by a board of your neighbors. In exchange, the HOA promises to maintain shared spaces, pools, clubhouses, landscaping, roads, drainage systems. That promise depends entirely on one thing: money. Specifically, a fund called the reserve account. The reserve is an emergency savings pool set aside for future repairs and major replacements ahead. Every well-run association should maintain a reserve study, a professional 20 to 30-year financial assessment and plan. Here is the reality. Most HOAs in America are not doing this. Not even close. An estimated 70% of HOAs in the United States are operating with dangerously inadequate reserves, not slightly underfunded. Dangerously underfunded. Some associations are sitting at less than 10% of requirements. For decades, this was manageable. Construction was cheaper. Materials lasted longer. Boards kept the illusion alive. Well-meaning volunteers with no financial training kept dues artificially low because nobody wants a higher bill. Low dues are how you sell homes in a new community, how you win board elections. Low dues are, quietly, how you set an entire neighborhood up for eventual financial collapse later. That's where the real problem begins. And the history of it goes back further than you'd expect. In June of 2021, a 12-story condominium in Surfside, Florida, collapsed. 98 people were killed instantly. Investigators found what the industry already suspected. The HOA had been warned about structural deficiencies for years. Repair estimates had been presented to the board. Special assessments had been proposed and repeatedly delayed. The board kept kicking the decision forward, hoping the costs would somehow become easier to manage. They never did. The Surfside collapse changed the legal landscape in Florida almost immediately and permanently. Florida passed sweeping legislation requiring reserve studies and full reserve funding on a strict fixed schedule. But the numbers revealed across Florida's condo communities after the law passed were absolutely staggering to see. Some Miami Beach associations discovered they needed to raise monthly dues by $800, $1,200, or more. Owners who had paid $600 a month for 15 years suddenly discovered everything was far from fine. In Hallandale Beach, a mid-rise community, beige stucco, small balconies overlooking a cracked asphalt parking lot. Interior hallways lined with thin, worn carpet and fluorescent lighting, unchanged since 2004. Aging in slow motion. That association sent out a special assessment notice to every owner, $85,000 per unit. Not alone. An immediate obligation. Some owners sold their units. Some couldn't sell. Some simply had no path forward. But Florida is not the exception. Florida is the preview of what is coming everywhere else. Outside Chicago, in a suburb called Schaumburg, there is a condominium complex built in the late 1980s. 3 stories. Red brick faded to a dusty rose, a building that once looked solid and proud. Inside, the units have low ceilings with popcorn texture. Carpet last replaced in 2009, worn thin. Windows that rattle slightly in winter wind. A galley-style kitchen, narrow, with laminate countertops and aging cabinets. It's not glamorous, but it's paid for. Several owners here are retirees who've lived here for decades. One is a 71-year-old woman named Sandra. She bought her unit in 1994 and never left. Last year, Sandra's HOA board sent out a notice. The roof was failing. The boiler needed replacement. The parking structure had drainage issues documented and deferred for 6 consecutive years without a single fix. The reserve fund had $112,000. The repair estimate was $1.9 million. Sandra's share of the gap, $14,600. She is on Social Security. She does not have $14,600. She has no clear way to get it. This is the human face of a reserve shortfall, not a balance sheet number, but a person. A 71-year-old woman under a buzzing kitchen light, trying to figure out what she's supposed to do. In Scottsdale, Arizona, inside a master-planned community opened in 2006. The aesthetic shifts to desert Southwest entirely. Stucco homes in terracotta and sandy beige, vaulted ceilings, travertine tile floors bathed in flat afternoon light, 2 pools, a fitness center, a clubhouse with a full commercial kitchen, all of it aging now. Pools need replastering. Fitness equipment wears out. HVAC systems don't survive a 110-degree Arizona summer indefinitely. A 2023 reserve study found this community funded at just 18% of its recommended reserve levels. The board held dues flat since 2019 to attract pandemic-era buyers. The marketing worked. The finances didn't. To address the gap, dues would need to nearly double, plus an immediate special assessment per homeowner, somewhere between $8,000 and $15,000 per household. Recommended immediately. Most homeowners had no idea it was coming. South of Atlanta, Georgia, a townhome community built around 2015. Dark fiber cement siding. 2-car garages throughout. Interiors with quartz countertops, LVP flooring, and open layouts that photograph beautifully for real estate listings online. The HOA board had been operating without a completed reserve study for 4 consecutive years. Nobody pushed back. When a new board member finally requested one, the results were presented at a poorly attended community meeting. Fewer than 30 homeowners showed up. The reserve was funded at 23%. Exterior repainting already overdue by 3 years. Roofs on the eastern cluster of units were entering their final projected service window. Time was running out. The board voted to table any special assessment discussion until next year. Not prepared to have that conversation. The conversation is coming, regardless of whether anyone on that board is prepared to have it or not. Here is how HOA financial collapse actually unfolds, not in one dramatic moment, but across many small decisions. First, a board keeps dues low to avoid conflict. Then a major repair surfaces. The reserve falls short. The board has two choices: raise dues dramatically or take out a loan and defer the pain. Many choose the loan, but loan repayments reduce what's available for reserves. The next repair finds even less. At some point, the board runs out of options that don't involve a special assessment letter going out. And that assessment lands in your mailbox on an otherwise completely ordinary and unremarkable Tuesday morning. When you buy into an HOA, you're not just buying a home. You're assuming shared financial obligations. Obligations that existed before you arrived, that you had no say in creating, and cannot walk away from. A special assessment is not optional. Failure to pay can result in a lien placed on your property. In some states, it can lead directly to foreclosure, even on a home with no mortgage at all. And this is where it gets worse. If enough homeowners can't pay, the association deteriorates even faster. Delinquency rates rise. Dues income shrinks. The board defers more maintenance. The cycle tightens around every homeowner. Lenders begin refusing to write new mortgages in communities flagged for known financial instability and reserve deficiencies. When buyers can't get financing, sellers can't sell. Property values stagnate, then fall. Then the spiral accelerates. There is a document called the HOA's Financial Disclosure Packet. In most states, sellers must provide it. It contains the budget, the reserve study, the meeting minutes, and the full balance sheets. Everything is there. Most buyers don't read it. Not because they're careless, because they're already drowning in paperwork by closing. The HOA financials are dense, formatted like an accounting spreadsheet, rarely explained by anyone in the transaction process. A buyer who doesn't know what a reserve funding percentage is won't be alarmed by 19%. Real estate agents have a financial incentive to close the transaction. HOA attorneys represent the association, not you. The board members who know the real financial picture are not in the room when the sale happens. Thousands of buyers every year purchase into financially distressed communities with no understanding of what they're inheriting legally. They close on a Friday, move in on a Saturday, and somewhere down the line, the letter arrives. But something changed in the last 3 years that is quietly accelerating all of this. That something is insurance. HOAs are required to carry insurance on shared structures. In stable markets, this is a manageable budget line. But across Florida, Texas, Louisiana, California, and parts of the Southeast, premiums have surged dramatically and relentlessly. Some associations have seen their master policy premiums triple in a single renewal cycle. Not over years. Overnight. For a 200-unit community, a $300,000 premium increase translates to $1,500 more per unit per year immediately. That's before a single dollar goes toward reserves or the deferred maintenance already waiting to be addressed. Associations already underfunded are now forced to choose between building reserves and simply keeping their insurance current. They can't do both, and they can't go without insurance. Every lender in the country requires it. Scene 100. In Florida, post-Surfside reserve requirements combined with insurance explosions have created situations with no mathematically clean exit. The math doesn't work at current dues. The math doesn't work at any dues these homeowners can afford. Looking ahead, the structural pressures are not easing. The trajectory for most vulnerable communities points in one direction. In the best case, legislatures expand reserve requirements. Insurance markets stabilize. Better management culture slowly takes hold over time. Over a decade or more, deferred maintenance culture gives way to something more financially honest and transparent for owners. In the more likely scenario, the adjustment is uneven and painful. The most vulnerable communities absorb the most damage. Older Florida condos, Midwest associations with aging infrastructure, Sunbelt communities with enormous amenity footprints and shallow reserves. Special assessments arrive in waves over the next 5 to 10 years. Property values in distressed communities fall steadily. Some associations cannot complete necessary repairs at all. Physical environments deteriorate, while homeowners remain legally and financially bound. In the worst case, certain communities enter a death spiral that becomes nearly impossible to reverse from inside. Scene 110. Falling values lead to declining collection. Declining collection leads to deferred maintenance. Deferred maintenance leads to further decline. A new category of housing distress emerges: the functionally stranded HOA community. Market value gone. Obligations fully intact. The people most exposed are not speculators, not investors. They are buyers who were told this was responsible. Retirees told a condo HOA meant no more maintenance headaches. First-time buyers told this was an affordable entry point. They followed the rules. They paid their dues. And the system they trusted was already running on empty.